Hello and welcome to the LP Financial Services Forex Training Class. In this training class, we'll go over an introduction to technical analysis. We will cover the main areas of technical analysis as related to the foreign exchange markets. We will cover four main topics in these lessons. Lesson number 1, we will cover chart patterns. Lesson number 2, we will cover candlestick charting. Lesson number 3, we will cover technical indicators. And lesson number 4, we'll cover moving averages. In lesson number 1, we'll discuss all the different chart patterns that one will use during technical analysis. Some people claim that by recognizing chart patterns, they are able to predict future stock prices and profit by this prediction. Other people respond by quoting, "Past performance is no guarantee of future results," and argue that chart patterns are merely illusions created by people's subconscious. Certain theories of economics hold that if there were a way to predict future stock prices and profit by it, then enough people use these techniques, they become ineffective and cease to be profitable. On the other hand, if you can predict what other people will predict the market to do, then that would be valuable information. In this lesson, we will cover the main charting patterns: double top patterns, double bottom patterns, head and shoulder patterns, reverse head and shoulder patterns, bull flag patterns, bear flag patterns, ascending triangles, and descending triangle patterns. In lesson number 2, we'll cover candlestick charting. A candlestick chart is a style of bar chart used primarily to describe price movements of an equity, or in our case, a foreign exchange instrument over time. It is a combination of a line chart and a bar chart, and that each bar represents the range of price movement over a given time interval. It is most often used in technical analysis of equity and currency price patterns. They are said to be developed in the 18th century by legendary Japanese rice trader Homo Manuhisha. The charts gave him an overview of open, high, low, and close prices over a certain period. The style of charting is very popular due to the level of ease in reading and understanding the graphs. In our lesson, we will cover the main candlestick charting patterns: bullish engulfing patterns, bearish engulfing patterns, bullish harami patterns, bearish harami patterns, piercing line patterns, and dark cloud cover patterns. In lesson 3, we'll discuss the various technical indicators. Technical analysts also use extensive indicators, which are typically mathematical transformations of price or volume. These indicators are used to help determine whether an asset is trending, and if it is, its price direction. Technicians also look for relationships between price, volume, and in the case of futures and foreign exchange, open interest. Examples include the Relative Strength Index and MACD. Other avenues of study include correlations between changes in price and momentum. Essentially, technical analysis examines two areas of investing: the analysis of market psyche or sentiment, and the analysis of supply and demand, whether investors have the funds to support their hopes and fears. A bullish investor without funds cannot take the market higher. In our lesson, we will cover the two main technical indicators: the use of the MACD, moving average convergence divergence indicator, and the use of the stochastic indicator. In lesson 4, we'll learn about moving averages. In statistics, a moving average or rolling average is one of a family of similar techniques used to analyze time series data. It is applied in finance and especially in technical analysis. It can also be used as a generic smoothing operation, in which case the raw data need not be in a time series. A moving average series can be calculated for any time series. In finance, it is most often applied to stock prices, returns, or trading volumes, and in our case, foreign exchange price movements. Moving averages are also used to smooth out short-term fluctuations, thus highlighting longer-term trends or cycles. An exponential moving average, an EMA, sometimes also called an exponentially weighted moving average, EWMA, applies weighting factors which decrease exponentially. The weighting for each older data point decreases exponentially, giving much more importance to recent observations while still not discarding older observations entirely. In our lesson, we'll cover the two main moving averages that we use in our analysis, the 50-day exponential moving average and the 150-day exponential moving average. So, we have now completed our introduction to technical analysis. In our next video, we will move on to lesson number 1, chart patterns, and discuss the various chart patterns that are used to analyze foreign exchange price movements.